Are you 3 to 5 years out from retiring and you're starting to notice the noise that's popping up in the newspapers about how markets are performing at the moment? This video is to give you a little bit of perspective about markets and also some strategies that you can consider to put in place for yourself to prepare yourself really well for retirement. So you can see here up on the screen, this is the S&P ASX 200, or the 200 biggest companies on the stock market, and you can see up here over the last month, this is a 1 month report, it's down 6.23%. So that really feeds into your emotions, particularly when you're thinking about your retirement monies, your retirement nest egg. Then if we look from a longer term view, this is the last 6 months. The overall return for the market has been 2.1%. And the other thing to keep in mind, this report and the reports that I'm showing you do not count dividends that are getting paid to you. If you happen to own the S&P ASX 200, you'll be getting dividends from those shares as well. But coming back to a longer term perspective on the growth side, it's at 2.1% over the past 6 months. Then if we look out even longer, we're now looking at a 5-year report, and that is a 29.51% return on the share prices for the ASX 200 over this 5-year period, and once again doesn't include dividends. Now, the next part of this video, I'm going to take a look at a strategy that you could consider building out for yourself as you prepare for retirement. So whilst I've only referenced the S&P ASX 200, everyone's, or most people's superannuation funds certainly have more investment exposure than just the ASX 200. It could be international shares, could be bonds, and other things. So let's have a look at what we call the bucket strategy to maybe help you navigate through this and build yourself towards a good retirement, and at the same time staying invested the way that you are, the way that suits you. And if you're unsure about that, reach out to us for advice. Now let's take a look at the bucket strategy. So here is the bucket strategy, and it's really relevant for those that are, 3 to 4, maybe even 5 years out from retirement. You're concerned about investment markets and how you're currently invested. You're contributing to super, and the tick box there is for the bucket strategy. So here is the information here. So let's assume, and this is what our client was doing, they were making $30,000 or the maximum tax deductible contributions to super. They were also considering putting in additional personal contributions to super as well. Under their current structure, previously, a month ago, they had $1 million in round numbers, and they are now at $960,000, and they are invested all in one in this one growth investment option. Now, the growth investment option they have within that also has some fixed interest and cash and things like that, but it's not segregated. So all they're seeing right now is my money went from $1 million down to $960,000. Now, part of this, the comments that I made with them, we think you need to be invested in some way, whether it's a growth investment option or other, that's suitable to you, to have the right amount of growth in retirement. But it's about having a good balance of having the right amount of what we call cash, or cash in your super fund. Now, not all super funds can offer this. So if we have a look at option 2, it's still the same super fund for the example here, and they still have $960,000 in their growth investment option. But now within the super fund, they have a standalone cash option that they have opened up within the super fund. And now for the next 4 years, they are going to contribute money that's come from a cash source, i.e. from their bank account or from their pay, into the cash account. This cash account is going to accumulate over time. That's guaranteed. Now, we're not sure what's going to happen in investment markets over time, but we do know that over the long term, investing is very likely to deliver you a much better outcome than cash. The statistics tell us that. Now, by accumulating this cash, in 4 years' time, they will have about $120,000 from these contributions, less some contributions tax, in this cash account, and they will be in a great position to be able to have real cash to draw from, and that allows the next 3 or 4 years of market movements to do what they do. Preferably they're all in the up direction, but if they are in the down direction, the client understands that long term they need money invested and dividends feeding this cash account for them to live a good retirement. So if you're unsure or not really a little bit too concerned about what's going on in the markets, that's a strategy that you could put into play. But you should seek out financial advice, and please reach out to me or reach out to your financial planner and have this discussion. It's a really good tool to help you navigate the emotional sides of investing for the long term, also the emotions that are associated with stopping working and having a permanent income and going into drawing from your own assets. So as mentioned, reach out, book in a 15-minute chat, and happy to help you navigate your situation.